In this video, we're going to talk about futures and forward contracts. So futures and forward contracts are contracts to buy or sell an asset at some point in the future. A forward contract is an over-the-counter contract between two counterparties and can be customized as much as one likes. A futures contract is exchange traded and highly standardized. So within the United States, and we'll spend some time on this website, many exchanges are owned by the CME group. And so we'll see some futures contracts later in this presentation. We'll see some futures contracts which are traded on the CME. So a forward contract is negotiated between two counterparties. It's often a corporation and a bank, but it might be two banks, it might be two corporations, but two counterparties. And the contract specifies what's going to be delivered, when it's going to be delivered, how it's going to be delivered, and of course, at what price. Now, the terms are negotiated between the two counterparties, and they can be customized as much as one likes. So for example, this is not a very customized contract, but an American company needs to purchase 475,000 British pounds. So GBP stands for British pounds. This is known as an ISO code, which is a three-letter code representing a currency. Many of them, or most of them, are pretty understandable. So GBP, Great British Pound. USD, US dollars. JPY, Japanese yen. Some of them are a little bit less. CHF, Swiss francs. ZAR, South African rand, and so on. So I'm never going to make you know what the ISO code is. I'm going to use them pretty regularly, but I'm not going to make you know them. I will always do my best to say British pound when I'm using GBP and so on. Okay, so this American company needs to purchase 475,000 pounds in 6 months. The current exchange rate is 1.31 US dollars per British pound. Again, I'm not going to make you know that the units of 1.31 is dollars per pound as opposed to pounds per dollar. I will always give you those units. In the real market, you're meant to be able to look at 1.31 and know that's dollars per pound. So they will just quote you a rate and you've got to know which way around it's quoted. So they agree with the bank to a forward rate of $1.32 per British pound for delivery in 6 months. Now in 6 months, the company is going to use the rate of 132 and deliver $627,000 and receive 475,000 pounds. So today they agree the rate 132, they agree the amount 475,000 pounds, $627,000, and then in 6 months the transaction takes place. Now, in that contract, there's not a lot of customization. But you can imagine if you're selling corn, then you might customize what grade, right? You're selling corn, you have a certain kind of corn in your fields. So you want to sell that corn, not just any old corn. You might specify where. You might specify the delivery date, or perhaps specify a set of dates over which you can deliver. You can specify how the delivery might be made. But of course, the more non-standard the contract, the worse the price will be to enter. So if you're selling corn, the more things you attach to that corn, to this contract, the lower the price you're going to receive. And you can imagine, this makes sense, right? If let's say I'm selling corn to a grain mill or grain depot, right? If I deliver it to them, I'll get one price. If I insist they come to me and pick it up, I'm going to get a different price, a slightly worse price, a lower price. Why? Because the company to which I sold the corn has to go and get it and bring it back. That costs money. So now the other thing about this customization, which is a negative, is that if I decide, right, so I agree. Let's go back to the U.S. company. I'm the U.S. company, and I've agreed to deliver $627,000 to receive 475,000 pounds. And then I decide that actually I don't want to do that anymore. I have to go back to that original counterparty and renegotiate. Right? I have to negotiate my way out of the contract. And there are two things that are going to go on. One, the exchange rate might change between now. The fair rate at which we would agree this contract might change between when the original contract was set up and now. And second, I'm negotiating a contract and I might not have gotten a great price. The company might have made some money off of me the first time when I negotiated the contract. They're going to make the same kind of money on me again when I renegotiate the contract, when I cancel the contract. And so this costs me money. Okay. Value of the forward contract depends on a lot of things. And we're going to just look in detail at some of these things later in the class. So one, the underlying asset. What is it? When does the contract mature? At what price have we agreed the contract? Again, go back to that corn. Have we made the company come to us and pick up the corn, or are we delivering it to them? Those delivery details are going to matter. Often, not always, but often, the contract is structured in such a way that the transaction involves no cash payment up front. And the way this is done is you negotiate all of the other details and leave the price until the end. So imagine, go back to that British pound example, right? The current exchange rate was 131. Let's say we're the company and we agree to pay $5 for every pound. That's a really terrible contract, right? Because we're paying way too many dollars per pound. We would expect to be paid money up front to enter that contract, right? And the money that we're paid up front offsets the fact that we're paying a terrible exchange rate at the back. Alternatively, let's say we agreed to pay 30 cents for every British pound. That's a wonderful contract. It's a really good value contract for us, but of course, we would expect to have to pay money to enter that contract. And given that 30 cents we would expect to pay money and $5 we would expect to be paid, there must be some price, the fair price, at which no money changes hands, right? Where we agree a rate and we're happy and our counterparty's happy and we think it's fair and therefore no money has to change hands. And so basically, one typically adjusts the strike, the agreed price of the contract, in order to have a zero present value contract up front. Okay, one of the other things, and again, we kind of hinted at this a little bit, as the market moves around, the value of the forward contract can change. There is a risk that one of the parties to the forward contract doesn't uphold their side of the agreement. Now, this is certainly true if the contract's really valuable at the maturity of the contract. So for example, let's say we've agreed to a forward contract to sell 100,000 barrels of oil at $50 a barrel for delivery tomorrow. So we agreed it 6 months ago. Now, if the prevailing price for oil, the market price for oil, is $75 a barrel, this company is losing a lot of money, right? Because they've agreed at $50 a barrel, and if they just ripped up the contract, walked away, and sold the oil in the market, they get 75. And so this contract is really valuable to the other party in the contract. This company, it's got a really bad negative value, but to the other party, it's got a lot of value. And if the company, in this case, defaults on the contract, the other company has a problem. So this is managed through a couple of agreements and then collateral. So the agreements, the first agreement is known as the ISDA-Master Agreement. So prior to any over-the-counter derivative contract being agreed between two counterparties, they will negotiate two contracts. The first is the ISDA-Master Agreement. This covers general terms and conditions of all derivative contracts. What happens in the case of default by one of the counterparty, but also just all the little details that one needs for a derivatives contract. And there are actually lots of them. And what this does is it means that for any specific contract negotiated between the two parties, it's probably a couple of pages, right? The ISDA-Master Agreement is sort of the boilerplate, everything else, all the little nitty-gritty details, but those are consistent across all contracts. And so once we do a particular contract, we only need to specify the details of that one, and then we refer to this contract. The key part of this, or one of the key parts of this, is known as the Credit Support Annex. So the Credit Support Annex allows for the netting of all derivative contracts, defines the collateral requirements, how much collateral has to be posted if the transactions go above some threshold level. What kind of collateral? Again, in the US, it's typically either dollars or US Treasuries. But again, if I'm a European company, there might be all sorts of collateral I can post. This allows for the termination of all derivative contracts if collateral is not posted in a timely manner. Okay, so let's think about that for a second. Let's say we've got a contract, we just negotiated it, it's fair, so it's got no value to either side. And then it goes $50,000, so the market moves, and now it's worth $50,000 to one of the parties. That party is allowed to call up the other one and ask for collateral. Again, we're assuming that's above the threshold. So they call up the counterparty, they ask for collateral, and this is a point where a lot of companies, if they're in trouble, they can't post the collateral. They don't have cash or they don't have treasuries in order to post collateral. The company who wants the collateral is at risk for about $50,000. If they let it go and they don't get the collateral, that $50,000 can grow. So they're allowed to terminate all of the derivative contracts, so just cancel them all, and seize the collateral that's already been posted if additional collateral is not posted. Now, collateral typically is two-way, meaning that both parties have to post if the contracts go against them. So again, company, Goldman Sachs, if the derivative contracts become more valuable for the company, then Goldman Sachs is expected to post collateral. If the derivative contracts become more valuable for Goldman Sachs, then the company has to post collateral. All right, we've talked about forward contracts. Now we talk about futures contracts. So futures contracts are available on a wide range of assets. They're traded on an exchange, and they have really precise specifications. So I can't negotiate my futures contracts. They specify what can be delivered, where it can be delivered, when it can be delivered. For each contract, there may be multiple maturities, typically monthly, although often not every month, extending into the future, sometimes months, sometimes years into the future. Profit and loss is settled daily through margin accounts, sometimes more than daily, right? It'll be settled almost immediately through margin accounts. The underlying asset has to be very precisely defined. So it's easy when we're thinking about foreign exchange, right? British pounds are all just the same. Tesla shares are all Tesla shares. But for other things, it might be very complicated, right? So you and I just think of crude oil and we just think of this stuff. Crude oil is a fairly complex product, and the futures contract for crude oil is going to be very precise about what kind of crude oil can be delivered. The asset has to have an agreed upon price. So we need a price which is verifiable and agreed. And again, it seems pretty straightforward for stocks, but imagine for a second that a stock doesn't trade on the futures expiry date or is suspended. And this happens all the time, right? It doesn't happen to a particular stock. It happens rarely. But if you've got thousands of stocks, some of them end up being suspended at particular points in time. And we don't know what the price is. And so now we've got a problem. And we've got to have some route or some mechanism for determining a fair price. The asset needs to be liquid and not easily manipulated. And again, we don't think a lot about this, but if we have a large cap stock, it's probably not manipulated very much. But a penny stock's a problem. An interesting example in the agricultural world, and I've posted a podcast on this, but there are no futures contracts on onions. And the reason there are no futures contracts on onions is because somebody in the 1950s basically bought them all. He cornered the market on onions and made a ton of money off of futures trading. And so it was decided to get rid of the futures contracts on onions because that market price could be easily manipulated. People have tried to manipulate prices in all sorts of things. So you can go look for all sorts of examples of let's see, we've got silver and aluminum and all sorts of products where people have tried to manipulate prices and then use futures contracts as a mechanism for making money from it. Asset classes are all sorts of things, right? Agriculture, energy, metals, financial, real estate, weather, and so on. There are all sorts of asset classes. And these asset classes, you and I think of corn and we go, it's just corn, but there's all sorts of kinds of corn. When you and I think of livestock, well, I actually don't think very much about livestock. Okay. There are contracts on livestock, there are contracts on feeder cattle, there are contracts on live cattle, there are contracts on what are known as lean hogs, which are carcasses, and so on and so forth. There's all sorts of asset classes. Futures are traded in lots. So one lot is the smallest quantity that can trade. Now, lot sizes were originally designed to be roughly $10,000 to $20,000 worth of the commodity. But of course, if we created lots in the 1970s and now we're 50 years later, they're not really $10,000 to $20,000 anymore. So each asset class has a different size, a different lot. So WTI crude oil, West Texas Intermediate, is 1,000 barrels. Live cattle, 40,000 pounds. Gold, 100 ounces, and so on. Okay, longs and shorts. And this is true for forwards as well. But a person who has bought a futures contract is known as being long the futures contract. If I've sold the futures contract, I'm short. A person who is buying a futures contract is going long. A person who's selling is going short. I will use long and short all the time and not think about that I'm buying and selling. I just think about myself going long or short. If I'm long a futures contract and the price goes up, I make money. If I'm short a futures contract and the price goes up, I lose money. If I want to close out a futures contract, I'd simply enter into the opposite position. So I'm long futures, 10 contracts. If I want to close out my position, I sell 10, the two net down to 0. The last point is that if we assume the asset underlying the futures trades liquidly, the futures contract trades liquidly, and there's precisely one delivery date for the futures contract, and some are like this and some are not, then the futures price should end up being the same as the asset price on the delivery date of the futures contract. So here we have the futures price in dark blue, the spot price of the asset in light blue, and you can see they're both wiggling around, but as we get closer and closer to the delivery date, that single delivery date, at the expiry of the futures contract, they should be the same. Doesn't matter whether the spot price is below or above the futures price, this is what should happen. Now, it doesn't necessarily happen, it's not necessarily true, but this is how this market should work.